Good morning here, Painless with Stock Strategy Circle with a active trade alert. Today, while going through the charts, I came across KNF, Knife River Holdings Company. It's currently trading around $80 a share, and it looks like it's about to break out of a kind of a high-level consolidation here. We take a look on the daily chart. Let me turn all of this noise off. We don't need to see the swings right now either. Turn that off. Okay, now let's just talk about the chart. Let's turn my drawing tools on. First thing we do when we take a look at a chart is we want to try and figure out what the overall trend is. And so we do that with trend lines. Not that difficult. We're going to go down here and we're going to select a low. And there is more art than science to this. So you kind of put them on a chart and you'll get a feeling for when it looks right. This is something that comes with experience. There you go. That's a little high. We'll put that right there. Okay, so what do you know right off the bat? This particular chart is in an uptrend. How do we know that? Well, because we have higher lows. When you have higher lows and higher highs, you go into an uptrend. Now, beginning back in March, we hit some overhead resistance, and let's go ahead and connect that up with a line. We'll take this high peak here. We'll connect it over to this high peak here. And so this gives us our resistance. But what we also want to notice is this previous area of resistance here, right? We rallied, we couldn't quite make a high, we fell off, we sold off into this area, and then we found support in around the $70 area here. Why is that important? Because it came down and it reconfirmed the previous uptrend. And that's interesting. So what that tells you is there's still buying pressure here in this stock. But what's more important about that is we have this area here, which we talk about in the course as a smile. We have a shakeout right here, right? We came through, we cleaned out all of these buy and sell orders that are going to be in here. And now we have just popped above this other established downtrend line. So what does that mean? Well, it may mean that this consolidation area is about to end. And so this is probably a pretty decent entry point. Now, remember, we practice money management. And so what's most important with any particular trade is you have to understand your account size. You have to understand how much risk you're willing to take in any one trade. And so I typically do that based on market volatility. And so that's why I use this volatility stop indicator that is provided with TradingView. So what I do is I try to account for the general volatility of a particular stock, and then I adjust my trade size accordingly. So in this case, let's say you wanted to risk $200 on this particular position. What you would do is you would take the price of where you're likely to get filled, and then you would account for the volatility. And so in this case, we got about $10 worth of volatility here. This would be assuming that you would close this position out if you got a close below 72. I think that's probably too high, because if you look, you can see that most of the support is really coming in around 65 or so. So probably what you should do is you should make a calculation from 65 to 80, which gets you $15 a share. Let's see, we have $15 times 100, that's $1,500. So you'd want to buy 10 shares, right? So if you came in here and you bought 10 shares, you would only be investing about $800. And you know in advance that if you make a close below this level here, you're just going to shut down the trade and get out. And so in this case, you're looking at risking about 10 shares. So I issued a trade alert already this morning because we opened above this. Current members of Stock Strategy Circle got this trade alert today. Now, how would I trade this in my account? Okay, let's turn the V-stop off because I prefer to use swings for my actual stop loss. And so I look for buy points when we get above a 3-day swing. And I like to place my stop losses below the 5-day swing. Now, why is that? Sounds like I have an upward bias. I do. I have a bullish bias for the stock market, and the reason is not because I'm insanely bullish and I'm super happy. The reason is because of inflation. If you take a look at any long-term stock chart, even companies that suck, for the most part, they have a tendency to go up. I mean, 30% of the S&P 500 probably shouldn't even be in business anymore, and yet the stocks continue to go up. Why is that? Well, because the government keeps printing money, and as long as the government's printing money, you're going to have inflation. So you tend to have a bullish bias on stocks anyway. Now, I only trade the most bullish stocks in any one time period in the market, which means the way I do my stock selection, I'm already looking for stocks that are going to be bullish. Now, these stocks tend to also be volatile. They go up quickly, they come down quickly, they bounce around everywhere. Okay, so you got to be aware of that. What I don't want to have happen is I don't want to get shaken out of a trade that turns out to be a good trade because I had my stop loss too close to the market. Placing a stop loss right here at 73.12 or so is an obvious place to put a stop loss. It's right below this area of support here. It's obvious. The problem is it just may be too close because the stock is so volatile. I mean, look at what it's done here in a period of a couple of weeks. It just cleaned all of this out. Now, probably you wouldn't want to stay in it through this anyway, right? That's not what I'm talking about. What I'm talking about is characteristically, the stock is volatile anyway. So really, what you should be doing is adjusting your trade size to account for this particular volatility. So if you don't want to risk any more than $100 on any one trade, you just figure out where for sure that if the stock turns the other way, it's got a broken back for sure, and it's no longer basing. And in this case, that's probably going to be around the 65 level. Right? So look at all this support in here. If it busts through the 65 level, this stock probably ain't going anywhere. But I don't want to sell it just because it has a shakeout day below 73. So if I want to risk $100, I'm going to take my fill price, which is going to be around $80 a share. I'm going to subtract out the support, which is around 65. That gets me 15 bucks per share of risk. Then it's just a question of how much risk am I willing to take. And so in this case, with 15 bucks worth of risk, if I want to risk about $100, if I do 10 shares, okay, that's going to risk 150 bucks. That's pretty easy. Now, if you don't want to risk 150 bucks, take a few shares off. And that's the real way to do your position sizing based on market risk. To just arbitrarily look at a stock and say, oh, I'm going to put $10,000 in this, and not account for the volatility is just pure insanity. It's a good way to blow up your account. So let's say you're one of those people who does that, right? And you're like, okay, I'm going to put in $10,000, but I don't want to risk, all of that. So I'm going to just put my stop loss here. That is total arbitrary nonsense. That may not be the right way to trade this particular stock. In fact, that would probably be a foolish way to trade this stock because almost invariably, when a stock like this goes up, it comes back down and kisses its previous level of support before it takes off, in which case you're going to get stopped out, you're going to get shaken out, and you're going to miss the move, all because you did your position sizing wrong. If you were looking at this stock and you wanted to get in for the major move, really you have to account for the volatility. To just arbitrarily throw a dollar amount in any one position is just pure insanity. And so what you will find when you account for volatility in your trades is that you're going to have trade sizes that are different for everything. Like you might have $800 worth of this one, right? Where you're going to have $2,000 worth of another one, $5,000 worth of one, and $500 in another one. Because you have to adjust your risk according to your account size. I typically use 1 to 2% of my account. But then the other thing I have to adjust for is I'm a cheapskate. I do not like losing more than $200 on any trade. So regardless of my account size, I will end up typically only risking 200 to 250 bucks on any one trade. And the reason I do that again is just because I'm a cheapskate. And so what ends up happening in my case, because of my account size, is I may have 40 open positions at any one time. And that sounds like oh my God, that would be so hard to manage. Not really, because the software today makes it super easy. I can page through everything in my account and make buy or sell decisions. It takes me less than 5 minutes. And mostly what I do on a daily basis is maintain the stock strategy circle. I'm not even in and out of my account all the time because it's not necessary. I buy leading stocks in a bull market that are going up, so I don't have to babysit them all that closely. Anyway, this was Knife River Holding Company. Technically, this stock looks really, really strong. We had a test of support, which was confirmed. We had a major shakeout. We have a smile. We have consistent volume. We have positive earnings. It's highly likely that if this stock breaks out, that over the next month, we're probably going to move, right here we go making a prediction, we're probably going to move 15 bucks to the positive. Well, why do I say that? Well, we have in this sideways channel here is about a $15 range. And so typically stocks will break out the width of their range. And so if we were to do that, we're just looking at 15 bucks, which 15 bucks from 80, actually the top of the range is in here, but whatever. But we're looking at getting close to 100. That's what I'm going to guess. Now, I'm not going to trade it that way. I don't typically do that anyway. What I'm going to do is trail my stop loss up. Once I get in a point where this position is profitable, I will move my stop loss up behind the market as it goes, trailing behind these swing areas of support. And if you see how successful that would have been here in the past with this stock, that's basically, the reason we do it. We get in stocks that are moving up, we stay in those stocks while they're moving up, and we sell them when there are signs of weakness. Here's a weekly chart of the same stock. And if you look at the weekly, you're going to see, look at that, 65.98 is pretty much where the swing level is on the weekly chart. And so this is going to be a pretty powerful area of support. Now, maybe nothing will happen with this stock. Maybe this stock will just move sideways. But what's important to understand is that we have controlled risk in the stock anyway. We don't have our whole account in it. In this case, if you're going to risk 200 bucks, you're only looking at having 15 shares, probably $1,000 or so. So if you have a $10,000 account, this is 1/10 of your account. What happens if you come across a stock that you want to move the money into? Well, you go into your account, you sell the stock that is performing the least. That will free up some of your capital in order to place a new trade. That's it. That's how you rotate through. Typically, you want to sell any position that you're losing money on, and that's it.